China is producing millionaires faster than ever, and this growth will not stop anytime soon. It's estimated to even double by 2026.
10 years ago, China's economy was the talk of the town. Imagine a country that had been sprinting forward for years. But here's the twist. Folks were debating if it would gently land or take a bumpy ride down. Then things got quieter, and China was celebrated as an economic superstar. But guess what? Some people still had their doubts, thinking that maybe China's economy wasn't as strong as it looked, especially in the property market. Today, we're diving into China's economic slowdown, why it's happening, what it means, and what might come next. Buckle up. This is a wild ride through China's economic adventure, China's economic transformation. China's journey of economic transformation over the last 4.5 decades is nothing short of astounding. Picture this. Not so long ago, China was a third-world country struggling with widespread poverty. People lived in conditions that were far from ideal, with limited access to basic necessities. Then, like a phoenix rising from the ashes, China began its remarkable ascent. It transformed itself into the world's second-largest economy, trailing only behind the mighty United States. The economic growth was so rapid that it left the world in awe. Factories sprouted up like mushrooms, producing goods that were shipped to every corner of the globe, making "Made in China" a familiar label on many products. The progress was undeniable, but it wasn't without its challenges. Despite facing hurdles and navigating uncharted waters, China persisted. It opened up its doors to the world, welcoming foreign investments and trade partnerships. This newfound globalization seemed to herald a new era of prosperity for China. However, just as the world was ready to embrace the post-pandemic rebound, a curveball named COVID-19 entered the scene. The pandemic disrupted the global economic landscape, and China was no exception. Expectations of a swift recovery were dashed, and uncertainty loomed like a dark cloud. The anticipated resurgence in trade and foreign investments, which many had hoped would act as a lifeline for China's economic health, failed to materialize as expected. It left economists and experts worried about the nation's financial well-being. The sudden and unexpected twist in the narrative cast a shadow over China's economic future. In this evolving economic landscape, China finds itself at a crossroads. The challenges it faces are multifaceted, and the solutions are far from simple. As we delve deeper into the complexities of China's economic slowdown, we will explore the causes, implications, and potential outcomes that could shape the nation's destiny in the years to come. To truly grasp the challenges facing China's economy, we need to examine some crucial indicators that shed light on its current state and future prospects. Industrial production. Imagine the heartbeat of a nation's economic engine. In China's case, that's industrial production. It encompasses everything from factories churning out goods to the manufacturing of essential products. Now picture this. Since 2010, this economic heartbeat has been gradually slowing down. But here's the kicker. COVID-19 came along and made things worse. What we were all hoping for was a robust revival post-lockdown. Instead, industrial production appears to be on a path towards contraction. It's like the vital signs of the economy are weakening. Property investment. Think of the real estate market as one of the pillars holding up China's economic skyscraper. It's not shocking to see this pillar starting to crack, especially with headlines about giants like Evergrande facing financial woes. Real estate has been in a state of frenzy, resembling a balloon inflating to dangerous proportions. Now that balloon seems to be losing air rapidly. When a real estate market bubble bursts, it doesn't gently deflate. It tends to collapse rapidly, causing financial tremors that affect not only the housing market, but also the broader economy. Retail sales. Let's shift our focus to the everyday transactions that keep an economy humming. Retail sales. These are the purchases we make, from groceries to gadgets. When retail sales are robust, it's a sign that people are confident about their economic prospects. However, right now, retail sales are showing signs of contraction in China. This suggests that consumers might be tightening their belts, a worrying sign that points to a broader economic slowdown. When people are less inclined to spend, it can have a domino effect on various industries. Now, you might wonder why these indicators are so important. They provide a snapshot of the overall health of China's economy. When they veer into negative territory and align in the same direction, it's like red warning lights flashing. It's a signal that something isn't right and that the country may be facing significant economic challenges. The challenge of deflation. Now, let's talk about a term that might seem a bit counterintuitive: deflation. Imagine a scenario where prices across the economy start to drop. On the surface, this might sound like good news for consumers. After all, who wouldn't love lower prices? However, the reality is a bit more complex. Deflation can create a whole set of problems. Picture this. When prices fall, it often means that businesses are making less money. When businesses make less money, they might start cutting costs, and that can lead to job losses. So, while you might be happy about cheaper groceries, someone on the other side of the transaction, like the worker who produced those groceries, could be making less money. Now, here's where it gets tricky. When incomes are slashed due to deflation, it can become challenging for individuals, businesses, and even the government to manage their financial obligations. Why? Well, debts don't usually shrink when prices fall. So imagine you have a big mortgage or a hefty business loan. If your income takes a hit due to deflation, it might become a real struggle to make those debt payments. This is why deflation can be a significant concern for China. China's soaring debt. Now let's talk about another pressing issue: China's debt. Debt can be a helpful tool when used wisely, but it can also become a burden when it grows too large. In China's case, debt has been piling up, and it's reached a level that's quite staggering. When we talk about China's debt, we're not just talking about one type of debt. We're looking at a combination of debt from households, companies, and the government. Collectively, this debt has grown to a whopping 282% of China's annual economic output. To put it simply, for every dollar the entire country produces in a year, there's nearly $3 in debt. Now, compare this to developed economies around the world, where the average debt-to-output ratio is around 256%. In the United States, it's about 257%. China has gone above and beyond, and this level of debt growth is not sustainable in the long term. For an economy like China's to keep chugging along, it needs its debt to keep growing. But there comes a point where that growth hits a wall. If China can't find a way to manage its debt effectively, it faces two potential outcomes: a full-blown debt crisis. This would involve a situation where China's debt becomes unmanageable, leading to widespread financial turmoil. It's a scenario that can have severe consequences, affecting not only China, but also the global economy. A prolonged balance sheet recession. Alternatively, China could find itself in a state of prolonged economic stagnation. This would be a situation where people and businesses are struggling to pay off existing debts, leading to a lack of spending and investment in the economy. It's like trying to swim with a heavy anchor tied to your leg. In either case, China faces a daunting challenge when it comes to managing its debt. Finding a solution is critical to ensuring the stability and sustainability of its economy in the years ahead. Real estate bubble. China's real estate market, once the envy of the world, is now facing a formidable crisis. The demographic landscape is shifting, with an aging population and soaring real estate costs making it difficult for young people to afford homes and start families. This has led to a decline in population growth, which is essential for a healthy economy. Moreover, oversupply issues have resulted in millions of empty housing units across the country, a stark indicator of the market's troubles. Developers are grappling with colossal debts, and the market that was once a symbol of China's economic might is now at risk of a significant downturn. Unemployment woes. The labor market in China is under considerable stress due to several interconnected factors. Youth unemployment is surging, with estimates suggesting it may be as high as 50%. Young job seekers are grappling with fierce competition and a scarcity of opportunities. Meanwhile, older individuals face age-related discrimination, which hinders their ability to secure new jobs or progress in their careers once they reach the age of 35. To cope with these challenges, families are resorting to a phenomenon known as the full-time children movement, where parents incentivize their adult children to stay at home rather than navigating a daunting job market. These employment woes cast a shadow on the economic prospects of both the young and the not-so-young in China. In essence, China's workforce, the lifeblood of its economy, is under duress. Youth unemployment is soaring, and older job seekers face barriers to career advancement. These challenges contribute to a complex economic landscape, where demographic shifts and employment concerns add another layer of difficulty to China's already intricate economic issues. Global implications. China's economic slowdown isn't just a domestic concern, it sends shockwaves throughout the global economy. As China's economic engine sputters, it has the potential to disrupt global investment patterns. Investors may seek safer havens for their money, shifting away from riskier assets tied to China. This flight to safety could have a ripple effect, slowing down global economic growth. Additionally, the slowdown could prompt multinational corporations to reconsider their supply chains. The prospect of manufacturing jobs returning to countries like the United States, where automation is on the rise, could become more attractive. This shift away from reliance on Chinese labor might alter the dynamics of the global manufacturing landscape. Geopolitical uncertainty. Beyond economic challenges, China's geopolitical actions and considerations cast a long shadow of uncertainty over its economic outlook. The situation in Taiwan, a contentious issue, has the potential to further destabilize the region. Experts like Kyle Bass and Ray Dalio have sounded the alarm, suggesting that China may take aggressive actions regarding Taiwan. Such a move could have profound implications, not only for regional stability, but also for global trade and investments. The intricate relationships between China, the United States, and other influential nations introduce a layer of unpredictability, making it challenging to foresee how geopolitical considerations will impact China's economic fate, and by extension, the global economy. China is facing significant economic challenges with a potential impact on the global economy. While the situation is complex, it's crucial to monitor China's economic developments closely and consider the implications for investments and global trade. The world is watching to see how China manages this crisis and whether it can find a way to stabilize its economy.